Is there a conservative way to trade stock options to make consistent passive income? Hi, I'm Wade Palmer, and yes, it is possible. I'm here to share my story of how I did exactly that using some of the most conservative and underutilized strategies in options trading, and that is selling cash-covered puts and asset-covered calls. Now, I certainly am not the only one using this strategy. I didn't make it up. I just happened to discover it and figure it out while reading books on the topic of options. I practiced it on a small scale many times and found that it not only provided a realistic way to create cash flow, but also helped me build my portfolio. Later on, I found others on YouTube and other places that were also doing the same thing. I'll list some of those sources in the notes below in this video. I think many of those do a better job than I'm going to attempt to do here in explaining the technical details of the strategy. It's also called trading the wheel or the triple income strategy. I like to call it be the casino, not the gambler. Why? Because the house always wins. I consider myself to be a buy and hold value investor with a dividend income focus. Some of my investing heroes include Warren Buffett, Charlie Munger, Joel Greenblatt, Phil Town, Peter Lynch, Bill Miller, Carl Icahn, and Benjamin Graham. Now, am I as good as them? No, of course not. Heavens no. But I keep trying to learn and grow by studying how they achieved success. I've read a lot of books on value investing, and I continually try and emulate the strategies that made these great investors great. So like I said, while trying to build this value and income-focused portfolio, I became interested in the options market, and after reading some books on the subject, I realized that there are some very conservative ways to support that goal, and that is by selling, not buying, calls and puts. I won't go into too much detail here on the technical details of put and call contracts, but some of the basics to know and review are that the owner or the buyer of a put contract has the right, but not the obligation, to force the seller of the contract, in this case me, to buy a certain stock at a certain price on or before a certain date. The good news is that as a seller of the put contract, I get to pick the stock, pick the price, and pick the date at which all this might happen. On top of all that, I get paid for doing all that choosing. So if I have the attitude that a certain targeted and well-analyzed stock is already desirable to me, it's already a bargain, then it's possible to get paid to possibly buy it in the future at an even lower price than it's currently being offered in the market. It's like selling an insurance policy on the future downward movement of a stock. I collect an insurance premium first. If the stock goes down enough, I happily buy it. If it doesn't, I don't buy the stock, the contract expires worthless, and I get 100% of the purchase money I put up as collateral back. Either way, I keep the insurance premium collected up front. If the put contract does in fact get executed, and I am forced to buy or assigned to buy the stock, I will essentially be getting paid to own the stock I already want at a cheaper price than when the contract was sold. Think of it as a contingent stock buy or a limit buy you get paid to make. Do you like a company but don't like the company's current stock price? Sell a cash-covered put and you can pick the price you would accept and get paid to buy it at that chosen price. Now, the owner of a call option has the right, but not the obligation, to force a seller of the contract, again me, to sell or call me out of a certain stock at a certain price on or before a certain date. Here I'm using the stock I own as collateral rather than cash. Again, I get to choose the price, the stock, and the time frame. So if I already own at least 100 shares of a company that I feel has already reached or exceeded its fair value after having done my own fundamental analysis, it's possible by selling an asset-covered call against my position to get paid to possibly sell it at a slightly higher price in the future than it's already selling at now. Whether I become obligated to sell the stock in the future or not doesn't matter. Either way, I win. I either sell it at an even higher price in the future than what I was already willing to sell it for and get paid for it, or I get to keep my shares and still get paid for having made the contract. As long as I'm okay with selling the stock at the selected strike price, this represents a conservative way to use a call option. It's like selling a lottery ticket to an excited speculator on the upward movement of a stock. I collect the lottery ticket price from the euphoric gambler up front. If the lottery ticket happens to win, I happily sell at an even bigger gain than I was originally willing to accept. If it doesn't, then the contract expires worthless and I keep all my shares. Either way, the lottery ticket price or the option premium is mine to keep. Think of it as a contingent stock sell or a limit sell you get paid to make. When you sell an option, whether a put or a call, you collect premium by selling time value more than anything else. I'm selling the time value to speculators, or gamblers using our casino metaphor, and receive the premium as income. The second the option is sold, time works in favor of the seller, me, and against the buyer or the gambler of any type of option. This allows me to be the casino or the house. Time is my edge, the house edge. No need to study stock charts for austere patterns or decipher a stock's mood or horoscope. Let the speculators deal with that voodoo nonsense. Most options expire worthless, and option premiums are guaranteed income to the seller of the option contract. The key thing to remember here is that I'm selling, not buying options. By collecting premium when selling options, I'm able to make money whether the stock targeted goes up, down, or sideways. As long as I'm okay with owning or selling at the strike price I've chosen, I can't lose. So if this strategy is so great, why doesn't everyone do it? Well, the biggest downside of selling covered option contracts is that it requires a lot more money than when you simply buy options. It's required as actual cash or as equity locked up in stocks you already own. Either way, you have to collateralize the contract sold. I'm the house, and the casino must have the money in the vault to back up any possible win by any gambler on the casino floor. That takes more money than any one gambler has in the casino. Buying options is much cheaper and the action much faster. Therefore, it tends to be more appealing. As the house, I just sit back and wait for time to work in my favor by slowly depleting the money out of the gamblers' pockets while they continue to play in the casino, hoping to hit the jackpot. The second downside is that if a contract gets executed or assigned to me, it technically represents an immediate paper loss on what could have been had I just bought the stock myself at the time of put assignment or sold at the time of call assignment. However, with my conservative strategy, those actions truly don't represent a risk, as my attitude toward the stock is one of happy to own or happy to sell at the chosen strike price. I don't have a crystal ball, and with or without options, there will almost always be money left on the table when buying or selling stocks. However, when selling options, if done right, it just increases the odds of making more money, both short-term and long-term. In early March 2020, the stock market crashed as a whole. It was the fastest bear market in history. The crash was mainly due to the COVID-19 pandemic taking hold. It struck fear and uncertainty into the stock market. Panic investors and fund managers alike sold like crazy. They sold everything. This was the moment I was waiting for, where most people were shocked and depressed to see their 401ks and their portfolios go down 40 to 60% in about a month. I was giddy. Now, yes, my 401k and my stock portfolio were way down as well, but I also knew that this was the greatest stock buying opportunity since early 2009. So I got busy moving as much money as possible into my stock brokerage account and doing fundamental analysis on quality companies, especially dream companies I'd always wanted to own. I was on a buying spree from early March until late October 2020. Sometimes I bought straight away, other times I sold puts and made cash along the way. If I got assigned, which it did happen several times, I was super happy to own wonderful companies at wonderful prices. Almost everything was on sale. It was an exciting, wonderful time, truly. In the middle of this bear market, I started to wonder about how I could scale up my buying. How could I take more advantage of the bear market and bargain basement stock prices being offered? I thought about using margin to buy more stock, but knew that that would represent taking on a bigger portfolio liquidation risk and didn't want to pay the interest rate offered. I thought, well, maybe if I bought a beat down blue chip on margin that paid a dividend higher than the carrying cost of the brokerage loan, I could minimize risk. I was still of the mind to buy stock directly as quickly as possible, but it was still a scary time to be a buyer, and I was running out of money. I had to constantly check my emotions against rational thinking and the fundamental math being presented by the market, which was clearly in my favor. Then in July 2020, while on a road trip drive home from a family reunion, my wife suggested the idea of getting a low-cost HELOC on our home and using the money not to buy stock directly, but to sell options on a much larger scale than what I had done up to that point. She had heard me talk about option selling success. Selling puts would give us one more level of safety and immediate cash flow before outright owning a stock. If we got put the stock or signed the stock, we could continue to make cash flow by immediately selling calls against the same position. If we decided to or were forced to hold the stock until it appreciated, we could collect a dividend greater than the cost to service the loan. Because of the huge implied volatility in stocks at the time, Option premiums were quite high, and I realized that if I could scale up my option selling this way, I could harvest a large amount of option premium while the market was still offering a substantial margin of safety on quality dividend-paying stocks. I needed a lot more money to execute this strategy, but I was lucky because there was a perfect storm going on: bargain price stocks and all-time low interest rates. After refinancing my house first, I got a $100,000 home equity loan from a local credit union offering a 1.99 introductory rate for 6 months. For me, this was a better option than using margin, where the rest of my portfolio could be put at risk of a margin call if things got worse in the market. I now had $100,000 to collateralize some serious put option contracts. The steps to the will strategy are fairly simple, but it is essential to start with quality fundamental analysis. The most important thing is to not lose your principal. The entire strategy, therefore, hinges on finding quality, undervalued stocks that pay a safe dividend. I came up with a set of personal rules for stock selection before selling any option contract. I incorporated these rules into the very first step. So this is my version of trading the wheel. Step 1. Use fundamental analysis to find an undervalued stock I would love to own. Ideally, this means a large, solid blue chip company, not a speculation stock, no bankruptcy turnaround stories, consistent return on invested capital of at least 5% over the last 10 years. Ideally, the targeted stock would be a dividend aristocrat, or at least one with an excellent dividend payment and growth history prior to the pandemic, with at least yield on cost of 5%. The dividend loan must cover the carrying cost of the HELOC. Solid earnings up through the first quarter 2020. Now, Q2 and beyond could be lousy due to the pandemic, but the company must have a solid earnings history otherwise. The targeted stock must have an intrinsic value above the strike price selected, ideally at least twice as high. I must be happy owning at the strike price if put the stock. Once decided upon, I will check the technical indicators such as the MACD, stochastics, and the 10-day moving average to attempt to sell the put contracts at a low inflection point where the stock is most likely to move upward in the near future. Step 2. Sell as many out-of-the-money, cash-secured put contracts as possible on the chosen stock using $100,000. The strike price must be fairly conservative, at least 2 clicks out of the money, that is 2 strike price points away from the current price. Ideally with at least 70% chance or better of expiring worthless, and the contract length should be 4 to 6 weeks, because time, or the theta decay, is fastest at 30 to 45 days. This allows for the highest option premium harvest in the shortest amount of time. And then lastly, the option premium collected should be at least $2,750, which equals the first full year of interest payment on the HELOC. Step 3. Avoid assignment and roll forward and down for a credit if I get close to getting assigned toward the end of the contract period. Or I'll buy to cover early if the put option contracts lose value very quickly, like 90% or more. In that case, I'll go to step 1 and start over. Or I'll allow the puts to expire worthless, and then again I'll go to step 1. Step 4. Get assigned to buy the stock. If none of the actions in step 3 are possible, I'll simply allow the options to be exercised. Step 5. Begin selling covered calls. Now that I own the stock, I can start selling covered calls against my position at a strike price above the purchase price. I'll also begin collecting dividends on that stock. Step 6. Avoid assignment on the call options now by rolling forward and up for a credit if I'm getting close to getting called out at the end of the option contract period. I'll continue to collect dividends during this time. Or buy early to cover if the call option loses value very quickly, like around 90% or more. I'll continue to collect dividends during this time, and then I'll go back to step 5. Or allow the calls to expire worthless. I'll continue to collect the dividend payments during this time as well, and then I'll go back to step 5 and repeat. Step 7. Get assigned to sell all shares at a higher price than they were originally purchased. Rinse and repeat, return to step 1. Okay, now finally on to what actually happened. This is not theory. These are actual trades that took place using this strategy, using real money. Okay, so on October 9th, 2020, I decided to target Simon Properties, ticker symbol SPG, for my first trade. Fundamental analysis showed that the stock was worth at least $100 a share. It was way undervalued and trading at just under $68 a share. I placed $96,000 in collateral with my broker and sold 16 put option contracts at $60 strike price, expiring on 11/20/2020. Each contract was worth $209, so I collected $3,344 in option premiums. So even after cutting their dividend early into the pandemic, SPG would yield a very safe 8.66% dividend if assigned to buy the stock at $60 a share. I was off and running. Okay, so things went well in this trade, but a month later, on November 9th, 2020, the puts lost 93% of their value in one day, which was great for me. This happened after news that the first COVID vaccine from Pfizer had exited final trials and would soon be made available to the public. I decided to get back in line and save time by covering my position early. So I bought back my 16 put contracts at $18 a contract, which cost me $288. My $96,000 in collateral was released back to me, and my net gain on the entire trade was $3,056. On November 25th, 2020, I targeted Brookfield Property Partners, ticker symbol BPY. Fundamental analysis showed that the stock's intrinsic value was worth at least $26 a share. It was undervalued and trading at well under $17 a share. I placed $99,400 in collateral with my broker and sold 71 put contracts at a strike price of $14, expiring on January 15th, 2021 for $70 a contract. I collected $4,970 in option premiums. Brookfield never cut their dividend during the pandemic and would yield a very safe 9.5% if I was assigned to buy the stock at $14 a share. Then on January 7th, 2021, these put contracts lost 96% of their value in one day after having lost over half of their previous value the day before. The stock had moved way up in a short amount of time because the parent company and majority shareholder of BPY, which was Brookfield Asset Management, recognized the extreme undervaluation of BPY and offered to buy out the rest of the company well above my strike price. I bought back my 71 contracts for only 3 cents a share, or $3 a contract, which cost me a total of $213. This was worth the cost because I saved a week of time on the contracts and could get back in line on another options deal. After I covered my position, my $99,400 in collateral was given back to me, and my net gain on the entire trade was $4,757. On January 7th, 2021, I selected Macerich, ticker symbol MAC. Macerich is another real estate investment trust, and it specializes in very high-end mall property. Fundamental analysis showed that the stock's long-term intrinsic value was worth around $55 a share based on tangible book value alone. Earnings were down due to the pandemic and real estate was unloved, but it was cash flow positive, and the net asset value of the property it held was way above the trading share price of about $11 a share at the time. I used the entire $100,000 available and sold 100 put contracts at a $10 strike price, expiring on February 19th, 2021 for $55 a contract. I collected $5,500 in option premiums. Macerich had recently cut its dividend to the legal minimum for a REIT. By law, REITs have to pay out 90% of their net profit to shareholders. Legally, it couldn't pay less, especially because they were still cash flow positive. So if put the stock at $10 a share, I would receive a dividend yield of 6% on my investment while I held. Honestly, I was kind of hoping I would get assigned the shares on this trade. This was a great deal. Around the end of January 2021, there was some incredible volatility in the stock market, especially regarding some amazing short squeezes on companies like GameStop and AMC Theaters, up 300 and 200% respectively. Now, Macerich was also a highly shorted company and also experienced a similar short squeeze, rising from $13 to more than $23 a share in less than a week, all while my contracts were in place. My puts lost all value possible without expiring worthless. Their value went from $55 a contract to $1. Again, this was very, very good for me. So on January 28th, 2021, I covered 3 weeks early by buying back my 100 puts at $5 a contract. Because the contracts traded in minimum increments of 5 cents a share, I paid $500 in order to get out of my contracts early and start the process over again. Net profit on this trade was an even $5,000 in only 3 weeks. Seeing that the short squeeze on Macerich was losing steam, I immediately took advantage of the high implied volatility in the option pricing and sold 71 new put contracts on Macerich at a strike price of $14 a share on January 28th, 2021. This action required $99,400 in collateral to be placed with my broker. Expiration was 6 weeks away. I collected $130 per contract, which netted me $9,230. Macerich was still trading around 25 to 50% of its net asset value with positive cash flow. It was still very undervalued in my opinion and would yield a safe 4.26% dividend if I were forced to or assigned to buy the stock. The 4.26 yield was a bit lower than my selection rules would otherwise allow, but I liked everything else about the situation and again was half hoping I would become an owner in March. This one was a bit of a nail biter. I decided to wait till the very end of the contract period to see what would happen and go long the stock if I was assigned to buy. The share price traded sideways just above and just below my strike price for the final 3 weeks. On the expiration date of March 19, 2021, the stock closed at exactly $13 a share. That's $1 against me or in the money. I expected to be assigned to buy 7,100 shares at $14 a share. Instead, I was absolutely surprised to find that I was only assigned to buy 4,000 shares or 40 contracts worth, using 56,000 of my cash collateral. The remaining 31 contracts somehow expired worthless, and the remaining $43,400 of my cash was returned to me. This trade was both thrilling and scary at the same time. I ended up with equity in an undervalued company from which I could sell covered calls, but also ended up with enough cash to continue selling puts. I kept the full amount of the option premium collected, which lowered my cost basis on the 4,000 shares purchased to $12.70 per share. Now I was in the position to do a split Step 1 and Step 5 of my Trade the Wheel program with both covered puts and calls if I wanted. Net profit was $9,230 in cash plus stock equity. On March 22, 2021, still pushing now with Macerich, I placed my remaining cash of $44,000 plus an additional $200 to sell 34 put option contracts at a strike price of $13, expiring on April 16, 2021 for $85 a contract. I collected $2,890 in option premium for selling less than 4 weeks of option contract time. The goal here was to sell some aggressive puts, complete my equity position in Macerich, and dollar cost average down a bit. If assigned to buy the stock in a month, these shares would yield 4.61% or an additional $2,028 a year in dividends. Macerich was still trading at a solid discount to intrinsic value. On April 16, 2021, Macerich closed at $12.60 a share, or just in the money. I had decided not to roll my position forward and allowed myself to be assigned to buy an additional 3,400 shares at $13 a share. I now owned a solid block of 7,400 undervalued shares of ticker symbol MAC, yielding roughly $4,414 a year in rock-bottom dividends. I was now out of cash, having spent $100,200, but flush with equity. Net profit on this round was a full $2,980 in option premium collected up front. As an owner of the stock, I was now all set to sell covered calls against my position. The blended cost for my 7,400 shares was $13.54 a share. However, my cost basis for those shares was only about $11.22 a share because of all the option premiums I had collected along the way. I waited until the upcoming ex-dividend date and Q1 earnings announcement before doing anything. Earnings were okay, about as expected, but the long-term forecast seemed very optimistic. On May 14, 2021, I sold 74 covered calls at a $17 strike price, expiring on 6/18/21 for $15 a contract. These covered call contracts netted me $1,100 in option premium. The buyers of my contracts bought the right to possibly force me to sell them my shares at over $3 higher than it cost me to buy them. If assigned to sell at $17, I would receive an equity bonus payout of $25,600. Okay, this was a rough one. This was my first losing trade in this whole cycle. I was forced to make a very tough decision and learned a few things in the process. During the last 2 weeks of my contract time, there was another short squeeze in meme stocks, as they're called. AMC shot up 330%. Mac traded up quickly in tandem, likely because AMC is a minority tenant of theirs. Now, if I had sold puts, this would have been a wonderful event, but I was holding covered calls. Mac shot up well past my $17 strike price and into the mid-$18 range in early June. My calls were in the money and worth far more to the buyer than I had sold them for. I was running a real risk of being called out of my position. I held tight for another couple of weeks to see what would happen. Mac traded mostly sideways and then finally down into the final week. I got nervous the final week of the contract period and had to make a decision. Should I allow myself to get called out of my position and make $25,600 if Mac stayed above $17 a share? Or should I try and roll my position up and out for a small credit at a higher strike price? Well, I went for the latter, but things were moving so fast on the day before expiration that by the time I bought back my contracts at a loss, the goal price of $19 had dropped in price too much for me to recoup all my losses. I missed my roll essentially, and in the end I decided just to take the hit and live to fight another day. So on 6/17/21, with Mac trading at $17.40 a share, I paid $4,440 to release my option obligation and keep my shares because I realized I just wasn't really ready to sell them for $17 a share, even though I would have made $25,600 in the process. On expiration day, Mac closed at $17.15 a share. I would have been called out. All right, well, what did I learn? Well, first off, if I'm in the money during my contract time, I should wait until the very last day of the contract period before making a decision to buy back my contracts. This will allow time decay to max out and give me every opportunity to cover at an out-of-the-money price. Mac did drop below 17 briefly after I covered. Even waiting a couple of hours would have saved me thousands of dollars. Secondly, I learned how to better execute an option roll on the Robinhood platform. Instead of executing a buy and a sell separately, I figured out it can be set up as a two-option trade to be executed simultaneously with the credit or debit established before execution. Knowing how to do this might have allowed me to roll up and out without losing any money at all. And finally, and most importantly, I was reminded not to sell covered calls at a strike price that I'm not truly willing to get called out at. Deep down, I realized that I just wasn't ready to let go at $17 a share. On the upside, during the contract time, I collected my first dividend payment from the company. On June 3rd, I was paid $1,110, which coincidentally was the same amount collected in option premium. After adding back in the premium collected, total loss was $3,330, with an additional dividend gain of $1,110, for a total loss of $2,220. I waited until after the second quarter dividend was paid before placing my next option trade. On September 9th, 2021, I sold 74 call options expiring on 12/17/21 at a strike price of $21 a share for $50 a contract. This netted me $3,700 in option premium. I sold a bit more time this time than usual and felt great about possibly getting called out at $21 a share in December. The equity bonus, if called out, would be $55,400. The COVID-19 Delta and other variants had stifled earnings expectations for Macerich, but it continued to improve its balance sheet during this time. In early November, a peer company of Macerich, Simon Properties, posted huge upside gains to net earnings and revenue. They also raised their dividend. This news sent Macerich and other similar REITs soaring. Macerich rose over 13% the day before its own Q3 earnings announcement, sending the stock price a little above my strike. Macerich's announced earnings on 11/3/21 were very good. They beat earnings estimates by 2 cents a share and on revenue by $11.56 million, which is a gain of over 14% over the last quarter. They also raised their Q4 earnings guidance. The stock rose to a high of $22.18 that day. I patiently held my contracts through all this volatility. By December 8th, things started settling down. I covered a bit early by buying back my contracts for only $10 each. The value of the contracts were beat down due to time decay and the fear of the Omicron COVID variant that hit the news right after Thanksgiving. I spent $740 to save 1.5 weeks of time and keep my shares for yet another round. As it turns out, the options would have expired worthless on December 17th. I netted $2,960 after closing my option position and collected 2 dividend payments of $1,110 each during this period for a total of $5,180. All right, so let's fast forward through one more round of sold covered calls executed on January 5th, 2022, where I collected $4,070 in premium and then covered 10 days later for $1,850. 2022 started out rough with another stock market correction. By spring, we were bordering on a full-blown bear market. Inflation was at a 40-year high at over 8%. Energy prices, especially oil, shot way up. Interest rates kept going up. The Fed kept pushing more and more fear into the stock market by threatening to raise interest rates even more and more often. A war in Ukraine put pressure on the world politically and economically. It was a struggle between fighting inflation and avoiding a full-blown recession. Similar to early 2020, stocks in general just kept going down. Earnings on perennial high flyers waned or went negative. Another buying opportunity? Perhaps, but I was already long Macerich in a big way and could only watch as my equity position eroded more and more every day. I held off selling covered calls during this time, but did collect a dividend of $1,110 on March 3rd. I would have rather liked to have sold out via call assignment. That was the plan, but on April 18th, 2022, I decided to quit while I was still ahead and live to trade the wheel another day. I could see that things were not likely to turn around anytime soon and sold out of my entire position at a price just above my cost basis. I sold directly all 7,400 shares at $13.86 a share for a small profit of $2,564. Well, that was almost one full circle example of the wheel, from one market correction to another. I hope this video showed that option selling can make you money even when your equity position does not. Total earned was $33,787, a far cry from the $100,000 plus payout momentum I had going at one time. Well, now I've got my 100K back and a fresh market crash to start all over again with.